We tend to think of the stock market as this world of pure logic, right? It's all about cold, hard numbers and super rational decisions. But what if I told you that the biggest force moving the markets isn't some complex algorithm or an earnings report, but something way more human? Today, we're going to dive into the powerful and often invisible role that our own feelings play in the world of finance. Okay, so here's our game plan for today. We're going to kick things off by mapping out that emotional roller coaster every single investor is on. Yeah, even if they don't know it. Then we'll pop the hood and look at our cognitive biases. Think of them as the little glitches in our brains that are actually driving the car. From there, we'll tackle the weird puzzle of why it is so hard to sell losing stock. Then we'll zoom out and see how all these individual feelings can add up to create a nationwide panic. And finally, we'll get practical and talk about real strategies you can use to stay in the driver's seat. All right, first up, let's really map out what it feels like to be an investor. It's this surprisingly predictable cycle of emotions, a roller coaster that pretty much mirrors the ups and downs of the market itself. I mean, this is really the fundamental question, isn't it? We all like to think that investing is a game of skill and careful analysis, but honestly, decades of research show us that our feelings, our hopes, our fears, they play a massive role in every choice we make. So there's this whole field that digs into this, and it's called behavioral finance. It's this awesome mix of psychology and economics, and it gives us the tools we need to understand why we so often act against our own best interests when our money's on the line. Now this is fascinating, because it lays out a cycle you've probably felt yourself. It all starts with optimism. When things are going up, that builds into excitement, and then it peaks at total euphoria, where you feel like a genius, like you just can't lose. But then, the ride takes a turn. Anxiety starts to creep in, which then turns into denial. As the losses get bigger, fear takes over, and that can spiral down into straight up despair. And it's only right there at that point of maximum pain, when it feels like all is lost, that the first tiny glimmer of hope can come back and start the whole wild ride all over again. So what is going on here? Why do we get stuck on this destructive emotional roller coaster? Well, the answer is actually in our own minds. It's a series of mental shortcuts and weird patterns called cognitive biases. You can kind of think of them as bugs in our mental software. And these are some of the biggest culprits. Take loss aversion. That's the reason a $1,000 loss feels way worse than a $1,000 gain feels good. It's what makes us sell in a panic. Or herd mentality. That's what makes us pile into a hot stock just because everyone else is, usually right at the top. And overconfidence? Oh yeah, that one kicks in hard when we're making money, convincing us we're investing geniuses who can't possibly lose. These biases are basically the fuel for that whole emotional cycle. Okay, now let's zoom in on a really specific and kind of strange behavior that these biases cause. It's something called the disposition effect, and it's all about our baffling refusal to sell investments that have lost us money. So, for a long time, the main academic idea was this thing called prospect theory. Basically, it said that when we're losing money, we turn into gamblers. We get riskier holding on for that miracle comeback. But then, some researchers did this massive study, looking at the trading records of literally every single household investor in Finland, and the data told a totally different story. It wasn't that we get riskier as losses pile up. No. What they found was this huge psychological wall, right at the break-even point. The second a stock goes from a tiny gain to a tiny loss, our willingness to sell just plummets. And this quote from one of the researchers, Marco Costia, just nails it. It points to a much simpler, more human reason. It's not about some complex calculation of risk. It's about our ego. It's about emotion. We hold on to our losers simply to avoid the pain of admitting we were wrong. See, as long as you don't sell, you haven't really lost anything yet, right? Selling makes the failure real. Okay, so we've seen how this works for one person. But what happens when these feelings of fear and anxiety get multiplied by millions of people all at the same time? Let's scale this up and look at the collective mood of an entire country during the 2008 financial crisis. I mean, the timeline is just brutal. The market was already feeling a little shaky, but when Lehman Brothers collapsed in September 2008, that was the trigger. It set off a full-blown panic. The market went into an absolute freefall, and it didn't hit the bottom until March of the next year. Just think about that number for a second. 57%. The market lost nearly 60% of its value. This wasn't just some abstract number on a screen. This was a devastating hit to people's retirement accounts, their savings, the entire country's sense of financial safety. And this right here, this chart shows you the human cost. Researchers were tracking the emotional state of Americans through daily Gallup polls, and look what they found. A massive spike in the number of people reporting high levels of worry and stress. And look when that spike happened. It lines up almost perfectly with the market's collapse. It's a direct link between financial chaos and a nation's emotional health. Okay, so we've seen the cycle, we get the biases, and we've seen just how big the impact can be. The final question is, what on earth can we do about it? Let's talk about some real, concrete strategies to manage these powerful emotional tides. So the good news is there are proven ways to protect yourself from your own worst instincts. The whole key is to build a system that takes your feelings out of your day-to-day decisions. Having a clear plan, diversifying your money, that's fundamental. But also, and this is a big one, stop checking your portfolio every single day. It's just an anxiety machine. Investing systematically, like with automatic monthly contributions, takes the emotion out of it. And honestly, the most important thing, just being aware of your biases. That's half the battle right there. And that kind of brings us to our final thought. Knowledge really is power here. Understanding the psychology of the market and your own mind is your absolute best defense against making those fear-based or greed-driven mistakes. But the real challenge for every single one of us isn't just learning about this cycle. It's remembering it when our emotions are screaming at us, in the absolute depths of despair, and maybe even more importantly, at the dizzying, intoxicating peak of euphoria.